Gold has just delivered the kind of move that makes investors feel like they are already late. After spending much of July trapped around the $4,000, $4,100 area, gold suddenly woke up, gaining roughly 4% in one day and then another 2.4% later in the week. From the Wednesday open to Friday's high, the move was around 7.2% in just 3 trading days. Silver joined the rally as well, trading around $63 in the source material. And this is exactly where I think investors need to slow down. Because when gold moves this quickly, after weeks of going nowhere, the natural reaction is not analysis, it's urgency. You look at the chart and think, if I don't buy now, I'm going to miss the entire move. That feeling is powerful, especially after watching gold sit still for a month. Suddenly, everyone wants to know the same thing. Should I buy now, or have I already missed the opportunity? But here's the problem. A fast rally and a sustainable bull market are not necessarily the same thing. The source material examined historical gold price data going back to 1975 and looked specifically at sharp 3-day rallies of 7% or more. It identified 26 such instances and asked a very simple question. After the spike, did gold ever return to that price or below within the following 6 months? The analysis found that this happened 25 times out of 26. That's approximately 96%. Now, before anyone turns that number into a trading law, there is an important caveat. 26 observations is a small sample. The source itself acknowledges that limitation. When the threshold was reduced to 5%, the analysis expanded to 62 instances, with 59 showing a retracement within 6 months. So I'm not saying gold must fall, I'm saying something much more useful. A sharp rally creates a different risk-reward environment from a quiet accumulation phase. And that's especially important right now because the recent move wasn't triggered by one massive structural change in the global monetary system. According to the source, the first major catalyst was the possibility of an agreement involving Iran and Oman that could help reopen the Strait of Hormuz. The logic was straightforward. If oil supply risks ease, oil prices can fall, lower energy costs can reduce inflation pressure, and reduced inflation pressure can give the Federal Reserve more room to consider lower interest rates. That chain is supportive for gold. Then came the U.S. jobs report. The source says July non-farm payrolls came in at negative 23,000, following a decline in monthly job creation from 214,000 in March to just 20,000 in June. That weaker labor market picture changed expectations around Federal Reserve policy, with the source saying market pricing for a September rate increase moved from roughly 65% toward 50%. Gold responded with another strong move. So look at what happened. Gold didn't suddenly rally because someone discovered that gold was valuable. The market repriced the Fed path, and that's the part investors need to understand. If the labor market weakens, traders may expect easier monetary policy. If inflation pressure also moderates because energy prices fall, the Fed has more room to respond. Lower expected rates can reduce the opportunity cost of holding a non-yielding asset like gold. That is a legitimate bullish catalyst, but it is also headline sensitive. The Hormuz development could change. The next employment report could surprise, inflation could remain stubborn, the Fed could maintain a restrictive stance. And if expectations reverse, part of the recent gold rally could reverse with them. That is why I don't want to frame this as gold is going down. The more intelligent question is, has gold entered a new structural phase, or are investors simply repricing a short-term change in Fed expectations? Those are two completely different stories. And before we decide which one we're looking at, we need to go deeper into the historical data, because if gold repeatedly behaves differently after these sudden vertical moves, that tells us something important about the danger of chasing the third green day. The rally may be real, the bullish thesis may be real, but the entry point is a completely separate question. Now, let's get to the part that actually caused this move, because the chart alone doesn't tell us whether this rally has staying power. The recent jump in gold was driven by a combination of geopolitical developments, oil expectations, inflation concerns, and changing Federal Reserve expectations. And when several macro variables move together, gold can react very quickly. The first catalyst came from the Middle East. According to the source, Iranian officials signaled that they were getting closer to a deal with Oman that could help reopen the Strait of Hormuz. That matters because the strait is a critical route for global oil shipments. The market's immediate reaction was straightforward. If the risk around the shipping route decreases, the pressure on oil prices can ease, and then the macro chain begins. Lower oil prices can reduce some inflation pressure. If inflation pressure becomes less severe, the Federal Reserve has less reason to maintain extremely restrictive monetary policy. And if traders begin expecting lower interest rates, the opportunity cost of holding gold can decline. That is a very important mechanism. Gold doesn't pay a coupon, so when interest rates and real yields are attractive, investors have a stronger incentive to hold interest-bearing assets. But when the market begins anticipating easier monetary policy, gold becomes relatively more attractive. That is why the Hormuz headline mattered. But then Friday brought another catalyst, the U.S. labor market. The source says July non-farm payrolls came in at negative 23,000. That followed a dramatic slowdown in job creation, from 214,000 in March to just 20,000 in June, before July moved into negative territory. And here is where the Federal Reserve suddenly finds itself in a difficult position. On one side, inflation remains above the Fed's stated target. The source puts inflation at 3.5% versus a 2% target. Normally, inflation running significantly above target would argue for keeping monetary policy restrictive, but on the other side, the labor market appears to be losing momentum. If employment is weakening, maintaining very restrictive policy for too long could put additional pressure on economic activity. So the Fed faces a classic policy tension. Inflation says higher rates, labor weakness says lower rates, and markets immediately began repricing that possibility. According to the source, traders had previously been pricing roughly a 65% probability of a September rate increase. After the weak jobs report, that probability moved closer to 50%. That is a meaningful shift. And gold reacted accordingly. But here's where I want to separate the price reaction from the underlying economic reality. Markets don't need the Fed to actually cut rates for gold to rally. They only need expectations about future policy to change. That's exactly what appears to have happened here. Traders looked at weaker employment data and started asking whether the Fed can really keep policy restrictive if the labor market continues deteriorating. Gold then repriced that expectation, so the rally makes sense, but it also tells us something else. The market is currently responding to expectations, and expectations can change very quickly. The Hormuz situation can change with another headline. The next jobs report can surprise in either direction. Inflation can remain stubborn, and the Federal Reserve can ultimately choose to prioritize inflation over employment if policymakers believe price pressures remain too high. That's why the source describes the current rally as being heavily dependent on a peace-related development that has not yet been finalized and one monthly employment report. This doesn't make the rally meaningless. It makes the rally fragile to new information, and that's an important distinction. A structural gold bull market would be supported by forces that persist regardless of one week's headlines, things such as sustained monetary demand, long-term reserve diversification, persistent inflation concerns, or a prolonged shift in global liquidity. A headline-driven rally is different. It can move violently because traders are rapidly changing their expectations. And that's why the next U.S. jobs report becomes extremely important. The source points out that another employment report is due in early September, shortly before the Federal Reserve's next meeting. If that report shows renewed labor market strength, expectations for a September rate increase could return. Imagine what that would mean. If traders go from expecting easier policy back toward expecting tighter policy, Treasury yields, and the dollar could react. Gold could then face renewed pressure. But the opposite is also possible. If employment weakness continues and inflation doesn't accelerate, the market could become even more confident that the Fed needs to ease. That would strengthen the bullish macro argument for gold. So right now, the market is effectively watching a tug of war between inflation and employment, and gold is sitting directly in the middle of that fight. Silver is participating too, but its situation is slightly different. Silver has a monetary component, but it also depends heavily on industrial demand. That means a weaker economy can create conflicting signals for silver. Easier monetary policy can support precious metals, while weaker industrial activity can create a headwind. This is why I wouldn't simply say, gold is rising, therefore silver must continue higher. The macro transmission mechanism is more complicated, and that brings us to the most important question of this entire rally. What would make this move structural rather than temporary? Because if the only ingredients are one geopolitical headline, one weak jobs report, and a shift in rate expectations, then the market could easily retrace. But if those events are symptoms of a much larger deterioration in the labor market, monetary conditions, and investor confidence, then this rally could become the beginning of something much bigger. And that is what we need to determine next. But now we have to answer the question that matters most. Is this rally actually different? Because being bullish on gold and chasing a 3-day spike are two completely different things. The recent move has a legitimate macro foundation, but the evidence in the source does not yet prove that the market has entered a completely new structural phase. What it does show is that gold has become extremely sensitive to changes in expectations around inflation, employment, and Federal Reserve policy. And that means the next move could go in either direction. Let's start with gold. The bullish case is straightforward. If the U.S. labor market continues weakening, pressure on the Federal Reserve to maintain very restrictive policy could diminish. If energy prices remain contained because geopolitical risks around the Strait of Hormuz continue to ease, inflation pressure could also become less threatening. Together, those forces could create a more favorable environment for lower interest rates, and that would potentially support gold. But there is another side. If the labor market stabilizes, inflation remains elevated, and the Fed decides that cutting rates would be premature, the market could quickly reverse some of the rate cut expectations that helped drive this rally. That's why I would not make the mistake of treating one employment report as a permanent change in monetary policy. The market is constantly updating, and gold is constantly responding. This is also why the historical data matters. The sources analysis found that sharp short-term gold rallies have historically often been followed by opportunities to buy at the same price or lower. Again, that isn't a prediction that today's rally must fail. It simply tells us that vertical price acceleration deserves caution rather than blind enthusiasm. Now let's bring silver into the picture. Silver has already moved alongside gold, with the source placing it around $63 during the rally. But silver is not simply gold with a lower price. Its industrial exposure makes the investment case more complicated. If monetary conditions become easier and investors increase precious metals exposure, silver can benefit. But if the economic slowdown becomes severe enough to hurt industrial activity, that can create a counterweight. So for silver, the question isn't just, will the Fed cut? It's also, what kind of economic environment produces those cuts? A rate cut caused by controlled disinflation and resilient economic activity could be supportive for silver. A rate cut caused by a much deeper economic slowdown could produce a more complicated outcome because industrial demand becomes a concern. Gold, by comparison, has the cleaner defensive and monetary narrative. That is why I would separate the two metals in this environment. Gold is primarily telling us about monetary expectations, risk, and confidence. Silver is giving us a mixture of monetary sentiment and economic cycle exposure. And this distinction becomes even more important after a sudden rally. When investors see gold and silver moving together, the temptation is to assume the entire precious metals complex is entering an unstoppable phase. But markets don't move in straight lines. The source itself makes an important point. Even when historical rallies eventually retraced, investors who waited weren't necessarily punished severely in the rare cases where the price didn't immediately become cheaper. In the 3 exceptions identified in the 7% test, the source says the maximum additional cost of waiting was around 1.5%. Again, I would treat that as historical evidence, not a guarantee, but it illustrates the central issue. The cost of patience can sometimes be smaller than the cost of FOMO. That doesn't mean sitting in cash indefinitely. It doesn't mean trying to predict the exact top. And it certainly doesn't mean abandoning a long-term bullish thesis. It means separating position building from market timing. If you have no exposure to gold and your investment horizon is measured in decades, one entry point may matter much less than building a sensible position over time. But if you already have significant exposure and gold has just moved sharply higher, there is less reason to feel that you must buy immediately. The source makes exactly this distinction by comparing different investor situations. Someone with decades before needing their capital has more time to absorb volatility than someone approaching retirement with an already large metals position. And that's a point I think is more important than any gold price prediction. The same price does not represent the same risk for every investor. Your time horizon matters, your existing exposure matters, your liquidity matters, and your ability to tolerate a drawdown matters. So what would convince me that this rally is genuinely becoming structural? I would want to see the macro catalysts reinforce each other rather than depend on one headline. I would want continued evidence of labor market weakness if the bullish thesis is based on easier Fed policy. I would want inflation to remain controlled enough for policymakers to actually respond, and I would want the market to continue repricing monetary conditions even after the initial excitement surrounding this week's headlines fades. If those conditions persist, then the argument becomes much stronger that this isn't simply another short-term spike. But if the next jobs report reverses the current narrative, or inflation surprises higher and the Fed remains restrictive, then investors should be prepared for volatility. That is the real test, not Monday's opening price, not the next green candle. The test is whether the macro story survives the next round of data. And that is why I wouldn't call this rally a trap yet. I would call it a warning against FOMO. There is a major difference. Gold can continue higher. Silver can continue higher. The long-term precious metals thesis can remain intact, and the market can still give investors a better entry point after this surge. Those possibilities are not contradictory. So as we move into the next phase, I would watch 3 things above everything else: the U.S. labor market, inflation, Federal Reserve expectations, because those 3 variables are currently sitting underneath this entire move. And if they continue moving in gold's favor, this rally could prove much more durable than the historical statistics suggest. But if they reverse, the market may once again remind investors why chasing explosive moves is so dangerous. And that leads us to the final question. If gold keeps rising, what should investors actually do? And if it retraces, where does the opportunity begin? So where does that leave us? After all the excitement, the answer is actually much simpler than the headlines make it sound. Gold can remain bullish without every short-term rally being a good entry point. Those two ideas can exist at the same time. The recent move has been powerful. Gold gained roughly 7% from the Wednesday open to Friday's high, while silver moved alongside it. But the historical analysis in the source suggests that sharp short-term gold rallies have frequently been followed by a retracement. The 7% test found 25 retracements in 26 historical instances, while the broader 5% test found 59 in 62. That is useful information, but it is not a crystal ball. The most important lesson isn't sell gold. It is don't confuse momentum with certainty. The recent rally was heavily connected to changing expectations around the Federal Reserve. A weaker U.S. labor market picture reduced expectations for a September rate increase, while developments around the Strait of Hormuz affected the outlook for oil and inflation. If those conditions continue, gold can absolutely move higher. But if the next employment report shows renewed strength, if inflation remains stubborn, or if the Federal Reserve signals that rates need to stay higher for longer, some of the expectations supporting this rally could disappear. That is why the next major test isn't simply the gold chart, it's the data behind the chart. Watch the labor market, watch inflation, watch treasury yields, watch the dollar, and watch what the Federal Reserve says about the path of interest rates. Those signals will tell us whether this is becoming a structural move or whether the market simply got ahead of itself. And there is another lesson here that applies to both gold and silver. You don't have to choose between buying everything today and buying nothing at all.